Welcome to the Explainer. Now, we all know Wendy's, right? The square burgers, the Frosties, the sassy Twitter account. But today, we're going way beyond the menu. We're going to crack open their 2024 annual report and get right under the hood to see how this fast food giant really works.
So let's start with the big question. When you think about a company with over 7,000 restaurants around the world, you probably think they make all their money selling you, well, Baconators and fries. But is that the full story? How does a giant like this actually make its money? The answer reveals a really specific and, honestly, pretty powerful business model.
All right, here's how we're going to break it all down. First, we'll look at their business model, what they're really selling. Then we'll get into management's four-part game plan for growth. After that, we'll do a quick financial health check, see how the numbers are looking. We'll also cover how they pay back investors, and then wrap it all up by looking at the risks and rewards on the horizon.
Okay, first things first, we have to get to the absolute core of how Wendy's operates as a company. And it all comes down to one word: franchising.
Okay, take a look at this. This chart tells you almost everything you need to know about their strategy. Of the roughly 7,200 Wendy's locations on the planet, the main corporation only owns and operates about 5% of them. A whopping 95% are run by independent business owners or franchisees. This isn't just a small detail, it's the entire game.
So here's the best way to think about it. The Wendy's company isn't really in the day-to-day business of flipping burgers. They're more like a giant real estate company and brand manager. They're basically a landlord selling the right to use the Wendy's name and system to thousands of independent owners, and then collecting rent and fees from them every month. And this right here is where you see the power of that landlord model in action. Look at the numbers. The tiny 5% of stores that Wendy's owns itself brought in about $926 million in sales. But look at the next line. From the other 95%, the franchisees, they collected $862 million in royalties and fees. Think about that. They make almost as much money just by collecting checks as they do from actually selling food, but without all the operational costs of running thousands of stores. It's a very efficient model. Okay, so if that's the business model, how do you grow it? You can't just decide to sell more burgers tomorrow. Well, lucky for us, management lays out their playbook very clearly. It's a strategy built on 4 key pillars. So here's the plan. Step 1. Get the restaurants you already have to sell more stuff. Simple enough. Step 2, lean hard into technology, mobile apps, loyalty programs, the whole digital experience. Step 3 is crucial for keeping their franchisees happy. Make each individual restaurant more profitable. And finally, step 4, keep growing the map by building more restaurants around the world. And this isn't some old strategy they're just dusting off. The brand new CEO, Kirk Tanner, who just started in February of 2024, is all in. He says they will, and I quote, relentlessly pursue our goal of value creation, which basically means this 4-pillar plan is the company's North Star right now. So what does this actually look like in the real world? Well, on the digital side, it means a better app and even testing AI in the drive-thru. For expansion, they're giving franchisees juicy incentives to build new spots. But here's a really telling detail. In 2024, their total number of restaurants didn't change. They opened 276 new ones, but they also closed 276 underperformers. This wasn't about getting bigger, it was about getting better, a strategic reset under new leadership. All right, so that's the plan. But talk is cheap, right? Let's check the scorecard. How did all of this translate into actual financial results in 2024? So at the very top, things look okay. Total revenues went up by 3% to $2.25 billion. But, and this is a pretty big but, as you go down the income statement, things get a little murkier. Both operating profit and the final net income actually dipped a bit. What that tells you is that even though more money was coming in the door, costs were rising faster and eating into their profits. Now, this metric is one that Wall Street watches like a hawk. It's same restaurant sales, which basically measures growth from existing stores. Globally, it was up 1.5%, which, okay, you can see things were a little stronger internationally than they were here in the US. But the really important question is, why did it go up? And here we are. This could be the most important takeaway from their entire report. That sales growth, it didn't come from more people coming in to eat. In fact, the report shows that customer traffic actually went down. The growth came entirely from a higher average check size. In other words, Wendy's made more money from fewer customers, mostly by charging them more. That's a very tricky way to grow your business.
So a company's making money. Now it has to decide what to do with it. Let's dig into how Wendy's gets that cash back to the people who own the company, its shareholders.
In 2024, the most direct way they did this was through dividends. They wrote checks to their shareholders totaling over $204 million. On top of that, they also went into the open market and spent another $75 million buying back their own shares. But get ready, because for 2025, this whole playbook is getting a major shakeup. Okay, check this out. Management is making a huge strategic trade-off here. They are cutting the quarterly dividend almost in half, from 25 cents down to 14. So where is all that cash going? They're redirecting it and then some into their stock buyback plan, which they're boosting all the way up to $200 million. This is a massive signal that management believes the best investment they can make right now is in their own stock.
All right, let's bring it all home. When we weigh everything we've just talked about, what does the future look like? Let's do a balanced breakdown of the headwinds and the tailwinds.
On one hand, you've got some serious risks. The report screams about fierce competition on price, rising costs for everything from beef to labor, and that really tricky problem of declining customer counts. Plus, because they're 95% franchised, their fate rests in the hands of thousands of other business owners. But, on the other hand, the opportunities are real. Digital and AI could be a game changer. There's a lot of world left to expand into, and you can't ignore the potential of a new CEO shaking things up, all backed by one of the most recognized brands in the world.
And you don't have to take my word for it. This quote from the report itself says it all. They are in a constant, knockdown, drag-out fight over price, quality, service, and speed. The fast food business is definitely not for the faint of heart.
So, at the end of the day, here's where we stand. Wendy's is making some big, bold bets. They've got a new leader at the helm, a controversial decision to cut the dividend, and a massive investment plan for technology and buying back their own stock. So the big question is, will this new recipe be enough to serve up the kind of growth investors are hungry for? Or will they just get grilled by the competition? That's what we'll all be watching. Thanks for joining The Explainer.